Let's get the morning briefing underway, and just going straight to the charts. Cable kind of capturing a bit of attention early doors here, given the fact that we've already this morning broken a fairly significant level, that being the low print that was seen yesterday afternoon. Yesterday's session in its entirety was a large down day for the pound against the dollar, coming in really what I would classify as two kind of phases. Phase one was you had the delayed Mansion House speech, not so much the Chancellor Philip Hammond, but more the Governor, Mark Carney of the Bank of England, coming in the context of what had been a hawkishly perceived Bank of England minutes on the vote split being 5-3, most hawkish we've had in many years. He came out and not really surprised, but maybe came against market position in the sense that he said now's not the time to be raising rates, not with anemic wage growth and concerns about consumer spending or mixed signals in that area. So much more clarity on the dovish side from the Governor, which obviously he speaks of the broader majority at this point. And so any concerns that we may have been in for getting towards the point of the UK hiking rates, or at least that time frame shortening, I think has been pushed back out again. And hence we saw a very aggressive quick move lower at around 8:30 yesterday morning. You then had the fast money move kind of pushing the price all the way down pretty much to the tick yesterday to its S2, before then reversing all the way back up to S1. At that point, with the spot price, that actually measured up with around 127 handle, and so it would have been potential point of entry, because then the second phase of the day we really broke down, as it continues to be the case that it seems that Theresa May is struggling to form an agreement at this point with the DUP, which is obviously critical for her to vote through the Tory kind of package, which is going to be outlaid by the Queen's speech later today. So we then broke lower, technically significant. Then we broke that hung Parliament low, which you can see I had circled up from yesterday. That saw the price action then continue to gain a bit of traction to the downside. Then as UK has come in this morning and the retail market, we've broken that low from yesterday afternoon, and again it's just extended some of the pressure to the downside here, amid reports that in the Telegraph, and we'll run through some of the headlines shortly, that the DUP may just walk away from the table. Obviously that would be highly detrimental to the Conservatives' minority government when they need those 10 votes that the DUP represent in the House of Parliament in order to push their policies over the line. So a lot of political uncertainty here, I would say, weighing most on the inability, if you like, to form a cohesive government. But also in the background, of course, you've got Brexit negotiations, which formally kicked off on Monday, and so the kind of pressure cooker on that front is also starting to ramp up. And so the negatives fundamentally are starting to stack up with that technical break yesterday that we had from the hung Parliament break. That might serve as a fairly interesting point of resistance on any recoveries from here, on the track lower, you would imagine, from a direction point of view. So that's the kind of story of cable. So just while I'm delivering this briefing, it's probably worth keeping an eye. I know a couple of you I can see are already in that short in sterling. Elsewhere, the other interesting thing was US equities yesterday. And one of the main reasons why we had US equities move lower, and we'll talk about oil in more detail through this briefing, but oil saw a considerable move to the downside yesterday, moving in terms of closing prices into bear market territory. So that means we've gone from a peak to trough of over 20% lower in crude in only a space of a few months. This then weighing on some of the respective sectors within the S&P makeup. I think a lot of this as well is in combination with the fact that if you look at where we were, I mean, this is an old chart that I had marked up previous. Let me just clear it up a little bit. but we'd gone into various kind of breaks higher, record territory. You can see here that was significant, 2400 we had at the end of May. We break higher, we kind of consolidation here, consolidation again, break higher again, with those recent record high territory we had printed on Monday. And so with oil being considerably lower, it did almost feel like a good point to probably investors were booking some profit up at these highly valued levels that we were tracking. And then in shorter time frames, there was a level which looked quite significant but has proven not to be too much support to the downward trend, which really continued all the way into the close on Wall Street. And so that was quite unusual in the essence that, well, normally what you tend to see is late on Wall Street we tend to get a bit of a recovery, but maybe with this push back lower now towards on the intraday S1 around this 2430, if we do start to move higher again, then probably I'd be looking at this kind of previous high and low range that we had been in for much of the month of June, and that being defined by 36 3/4 on the upside, as highlighted here from these previous resistance points. On the downside, obviously 24.20 1/4, and then below there also those points from the 12th and 15th support at 24.16 1/2. But obviously the preference still that if we get towards the lower bound of some of the June range, I would say probably there's going to be pretty good levels of support, because we tend to see equities supported at around these levels, and they don't tend to go down for too long, as we well know at this point in time. The DAX then this morning looking a little bit negative, down about 100 points. We did yesterday, we gapped up obviously much of the morning. Though quite a few people were looking at that short when we eventually broke it kind of late morning. It's a little bit difficult to execute because it took a little while for it to really start to take a considerable dip, and it wasn't really until the US came in and we saw the broader volumes across assets start to pick up a little bit, and we started to then follow suit when the pressure commenced on the open on Wall Street. That was enough then to break the subsequent pivot level in the DAX, and then we just trended lower and lower. Now this morning in the futures market we've had another extended move to the downside, this then following the negative close on Wall Street. That fed through to a broadly negative Asia Pacific session, and so hence we trade back to where we are at the moment in the DAX, which is in negative territory. Okay, let's get stuck into a couple of headlines then. And one thing just to have a quick look at here is oil prices and where we are this morning. This was yesterday's move. So we went from kind of European morning, we were trading at 44.50. We got all the way down to briefly break 43. So a decent $1.50 move, which is fairly large. By no means the largest move that you guys will probably have seen, but on an intraday level it's significant. And this morning we've had a new bout of selling pressure pretty early on, however we've steadied more recently, but 42.94 to be watched quite closely. Now why are we moving lower is kind of the question. A lot of people, given the gravity of and the speed of the move yesterday to the downside, questioning, you know, what have I missed? What was the headline? And the key thing to understand here is that there wasn't really a headline. This wasn't a headline driven move. This was purely really a break technically of the low from yesterday, and it comes amid what is a growing sense of bearish factors that are far outweighing bullish ones at the moment for the crude market. So let's have a quick talk about what those factors are. Now we know about US output, and so I don't want to talk about US output too much, but a long story short, the break-even price of production of shale in the US has become considerably cheaper and cheaper over a very short period of time. So i.e. a number of just 3 to 5 years, technology has moved so quickly that the break even in some of the biggest sites in North America has dropped from around $50–$60 all the way down to about $35. So at this point in time, if you were looking at WTI crude, you would say you're still in the money by a clear kind of $8–9 in the case of the US. So why not continue to pump more oil in order to pressure OPEC when you know when it gets down to $40 in WTI, OPEC are going to start feeling more and more pressure to want to step in to intervene to prop up prices, because at all this point, and for most of the OPEC nations, the further we go away really from $100, that means that all of these countries are losing money. And the point being is that most of these Middle Eastern or Gulf nations are heavily dependent on the sale of oil to generate majority of the income for their countries in order to balance their fiscal budgets. So at the moment they're all feeling the pain. So that's the US output situation, and we know the deal with the rig count. 22 consecutive rigs have coming back online, with US crude output tracking ever more higher in competition of producing close to what Saudi and the Russians are. The other key parts of the equation here are the two countries which were exempt from the initial OPEC agreements. Those two countries were two countries that were under heavy kind of civil tensions at that point in time, disruptions then to their crude oil supply, which meant that they did not have to adhere to cutting production because their production, in a sense, was impeded by those factors just mentioned. Looking at Libya then, one of the interesting things here is that Libya, actually this chart is the most latest one I could find, but actually latest data would suggest that Libya's production value is now up at 900,000. So if I was to just extend that line just up to this point here, it means that Libyan production from really, we're looking at March, April time, has gone from about 570 to 900. So you're talking, it's almost doubled its production as some of its largest fields come back online, which had been disrupted previously because of ongoing security issues that they had had. Now, to put this into a bit of context, we're saying Libya then has improved its production by, let's call it circa 300,000. Don't forget the OPEC number of the agreement of the global cut in production at the moment, as per the Vienna agreement, is for 1.2 million, because the other 600,000 comes from non-OPEC names, namely Russia. So already then you're subtracting almost 300,000 on Libya alone from the impact that 1.2 million cut is going to have. Then you start to throw in Nigeria, and Nigeria produces slightly more than Libya. And one of the main things that you've got here is at the beginning of the month of June there was a very important development in Nigeria, and that was that the Forcados exports, so Forcados site, actually came back online. And if you look at that particular facility, when looking at the breakdown of all of the individual key sites across Nigeria, Forcados is by far the most important, i.e. the size of its production. It's about 200,000. Now at the beginning of June, Forcados was coming back online after, I think it was something like 14 months of disruption due to dealing with militants and security issues, much like Libya. So then you're adding to Nigerian supply potentially another 200, Kua Iboa, so another 150,000. So then you're looking at numbers circa 3, 4, possibly 500,000 barrels of oil coming back online for Nigeria. Plus then your 300 from Libya. This takes your OPEC cut to something like then 200,000, which is absolutely insignificant when you think about the size of production that these guys as a collective OPEC are producing. So this is why the market is in such a bearish kind of mood at the moment. not only are we getting squeezed by increasing US output, which looks like it's only going one way at the moment, not forgetting the backing of the US, the new Trump-led administration, which is very pro American independence, very pro in terms of making the energy sector more affluent, if you like, in regards to easing regulatory rules, and also about their policy stance on being very little care for the environment means it's kind of game on as far as the US oil industry is concerned. Then you layer in this situation about Libya and Nigeria, and it starts to stack up, if you like, why the market is acting like it is. This is another interesting point as well, is that if countries like the US are pumping something like 9.1 million, Saudi are doing a similar amount, as to the Russians. This is not even mentioning Iraq and Iran and all these other countries that are producing themselves something like 4 million as well. Is that the amount of oil held at sea in tankers is growing despite OPEC's production cuts. What this is saying then is that traditional onshore storage facilities are already full. Therefore now people in the oil industry will be tracking shipping routes, but what we tend to be seeing is that the storage of oil at sea, tankers lying dormant because there is a lack of demand for the oversupply in the market, is increasing at this point. So at the moment there's some 100 million barrels of oil just sitting there in tankers because of this oversupplied nature of the market, because while the US and OPEC do battle all the time, the demand is not changing and the supply is getting ever greater. So again, more negatives in terms of how oil might play out in the long term. Going back to the chart then, although you might get these slight pullbacks in price, I think it's been pretty evident that oil's kind of going one way at the moment. I mean, looking at the last few days, this is June we're looking at, we've had some quite sharp bouts of moves lower as we've gone through that period. Then if you look longer term, obviously now I'm looking on my bottom axis of years from 2014, 2015, 2016, 2017. Now for the new traders, let's not forget, oil has been a lot lower than where it is at the moment. This is by no means kind of crisis point, although it fiscally you could say that it is in terms of a lot of the Gulf nations. They have been in worse times, that being back in February of 2016. This was when people were fearing of a hard landing in China, which obviously would be detrimental for global economic growth and demand in the commodity space, in addition to US output was increasing at the time. So that fragility of global economic growth saw crude move all the way down to around the $26 handle. Now we're trading 43.24 at the moment, so we're at the lowest levels we've been really since November of 2016, but you can see there's a fairly big level coming up here. We're only around $1 away from it at the moment, and that's 42.20. That being the November low. That was also around the low point of what we had in the summer of 2016, and that was also the March 2015 lows as well that we had. A break of that level, you would argue, then may open up the doors for a run down to $40. Psychologically, that would be a big level and target, and then below there 39.19, which starts then to be another technical level of significance from previous prices. At what point then does OPEC start to up the ante with the verbal intervention? I think that we need to see a break of this 42.20. If and when that happens, I think the closer we get to 40, they'll start to ramp up the commentary. I don't think they'll want to step in too soon at this point, given the fact that if you start commenting at every ebb and flow of the crude market, the impact of your comments diminishes over time. OPEC will be very mindful of that, because in actuality they don't want to take further action. They've only just put out this agreement on the 25th of May. That was under a month ago, and prices have already gone $10 against them at this point. The last thing they want to do is start committing to larger cuts now, when they've got to navigate another 9 months before the current extension deal is concluded. So I don't think they're going to be stepping in until we get more to around 40. They'll up the commentary. If they were to take any real action before the March 2018 deadline of the current 1.8 million cut over that 9-month extension, I think we need to get lower than 39.19. As soon as we get down towards the lower levels of 35 and so on, if we got down there, then they might be forced into a situation where they've just got to start changing the numbers around that deal. One interesting thing that we had yesterday was the S&P did see a little bit of weight. It kind of almost acted as a reason to book a bit of profit on the recent run higher we've had in US equities. Obviously it had traded at record high territory. But one interesting thing here that I saw was that in terms of the S&P, an interesting statistic here is that since the beginning of the year, let me just find the stat here. So since the beginning of the year, the oil industry, because of the fall in prices, has lost circa, in terms of, I guess this is company valuations, something akin to around $200 billion in market value. What this has meant then is that if you're thinking about a proportional makeup of a sector of an index like the S&P, energy stocks then have suffered under the weight of a falling price, and that means then that if you look at energy weight of the S&P index as a proportional weighting is now much smaller than it was only several years ago. So if you were to turn the clock back down to the period of probably 2008, so just before the original onset, I guess, of the financial crisis, the energy sector of the S&P was a contributing factor of around 16% of the entire index. So if you're looking for a correlation play, anytime that oil moves significantly, you could quite comfortably say then there would have been a direct impact of a higher value than would have had on the S&P. However, given the depreciating valuations of energy firms, their proportionate weight has decreased to a point where it's 6%. And that puts us back down to the early noughties. So it means that irrespective of where oil moves, actually its ability to move the overall index has lessened, if that makes sense. Certainly yesterday that kind of proved a little bit wrong, because I think the market really dwelled on that fact that oil got hit quite hard, and it just added as another reason to book some profit. But certainly this is quite an interesting way to look at the crude market in future. Other things to look at, we did have the API crude oil inventories last night. I would say that these were largely uninteresting numbers, but to recap so you are aware, we had a crude API headline, a drawdown of 2.72 million. That was a slightly larger drawdown than expected, so that in itself would be bullish. Cushing was a drawdown of 1.269 billion, that would be bullish. Gasoline, a build of 346,000, that was slightly below expectations, that would be bullish, whereas distillates were up, a build of 1.837. The important thing here, I think, to realise with crude is that really these numbers at this point, especially a report like this where the numbers aren't that outlying, in the context of things, there is a much bigger story ongoing in the crude market at this point in time. And unless these inventory numbers start to become sizable in either direction, certainly if they become very big size builds, then they would draw attention. But at this point in time, I think certainly this report, people have kind of brushed it to the side. It's just some data to be aware of. I would say more so the market is focused on some of the bigger stories at play, as we've just discussed. On that front, to round up the oil section kind of of the briefing, this was a headline that's happened overnight, and I think this is quite interesting. It's certainly not a tradable event, but it does show a lot, I think, of the Saudi Arabian thinking going forward. I've talked about a lot before about how one-dimensional a lot of these Gulf nations are, Saudi Arabia being one of them. They've had such a monopoly on the global crude oil market for such a long period of time. They've almost been caught by this shale industry and how quickly it's come online. And what's been interesting is that we've heard before the Deputy Crown Prince was named. This was only a few years ago when Prince Mohammed took place, and he took the kind of second in command position where he was overseeing things like the economy and the oil industry. However, he has now assumed the kind of top job, if you like. So he is now being named as the Crown Prince. Now, I think this is interesting because if you think about this chap in particular, he's a lot more, now that's not to say he is overtly moderate, that's probably not the case, but he's a lot more moderate or more modern thinking than a lot of the traditional old hierarchy of this Saudi Arabian family. And as such, this is quite an interesting play, I think, on him being put into place in order to diversify the country's revenue streams. You think about things like the IPO of Aramco that's coming up at the beginning of next year, the kind of new method that the Saudis have now enacted, which is verbally looking to intervene rather than using physical action. These are all quite interesting developments of a person who is looking to change tact, if you like, slightly of the Saudi Arabian approach. So in the background, I think this is politically a big deal, but in terms of trading oil short term, I don't think it makes a huge amount of difference. Okay, let's move on. Theresa May, obviously looking at the pound this morning, we mentioned it's looking a little heavy already, and there's a couple things to be aware of today, that being the Queen's speech. So the Prime Minister will go into the Queen's speech, which marks the state opening of Parliament. But the key thing here, she has no guaranteed parliamentary majority because as of yet, she's not managed to strike a deal with the DUP. Arlene Foster, who's the DUP's leader, has indicated her party of 10 MPs will join the 318 Conservative members to vote in favour of accepting the Queen's speech. But headlines such as this have certainly kept nerves a little unsteady, where MPs, according to the Telegraph and DUP, have threatened to walk away from the deal to prop up May's minority government on the eve of the Queen's speech. This came out last night. This is what's probably causing a little bit of renewed sterling weakness again this morning with that break of that technical level. Now, a few other things to be aware of here. In terms of the detail, what are we going to hear in the Queen's speech? That's likely to be dominated by a repeal bill, which will be provided, or which will provide EU legislation to be transferred into UK law and will spurn hundreds of pieces of technical legislation. So this is really some of the more legality side of the Brexit situation. May will attempt to prove her government still has ideas for social reform by publishing a range of bills to help ordinary working families, and no doubt a big counter-terrorism package is probably also to be expected, just given the series of events which have taken place more recently. But Mrs May will be forced to abandon many of the policies in the much criticised Conservative manifesto, knowing she'd be unable to force them through in a hung parliament. So if you remember about those manifestos, things like new grammar schools, the end of free school meals for infants, the cut to the number of MPs, all these different things she's likely not to mention because she does not want to rock the boat at this point. She just wants to get over the line, so to speak, with some of the broader outline of things, particularly with emphasis on Brexit. Now, where does this actually lead to? Well, in terms of the Queen's speech, it's followed by several days of debate and then votes on June 28th and 29th is when they'll vote on what actually is being put forth by the government. Now, at this point in time, the broader expectation is then that even though the DUP are threatening to walk away, is that you still have, or Theresa May still has, until next Wednesday and Thursday votes, so another week to get the DUP on side. Now, I would say baseline expectation is that the DUP, when it comes down to it, will vote in order to support what gets put forward in the Queen's speech from the Conservatives. There is obviously a risk there to monitor as we go through the period of negotiations with them. but there's still a little bit of time for Theresa May to work this out. If we then go on to a point where if they fail to back the Conservative government, then things obviously get interesting. The opposition Labour Party are likely to put down amendments. More than 50 lawmakers from Corbyn's Labour Party have signed a letter yesterday calling for Britain to stay within the EU single market. So Corbyn is kind of waiting in the wings, if you like, if that latter situation does arise. And if it does, then we go into the next phase, if you like, of trying to form a government, which just delays the Brexit process. So in the short term might add more negativity in that regard. This is the kind of timetable that we're looking at for today for the Queen's speech. So the Queen, Prince Philip arrive at the Palace of Westminster. It kicks off then. The Queen takes her seat on the throne in the House of Lords at 11:30 is when it commences. I got asked this question yesterday. The Black Rod summons the MPs. That's the officer of the House of Lords. He's chairing over, if you like, the whole situation. And then 2:30, the Queen's speech debate begins in the House of Commons. So that will be quite fascinating to watch on live TV at the time. Particularly, let's see how Corbyn puts up a good opposition argument in what is pretty much, he's not going to get much a better opportunity to have a pop at the Prime Minister than today. So it'll be a good test to see how confident he is of the situation at this point. What you might hear today, though, from a press point of view, is the Day of Rage protests. This is a common thing which happens whenever the Queen speaks at these speeches. But today we're expecting 3 separate demonstrations to take place in the capital, which has prompted some concern about potential for these turning violent, given the kind of social unrest that the Grenfell Tower situation had caused amongst the general public, particularly in London. So I would be keeping a half an eye on this. I guess it's how, if it was to take a real violent turn in protesting, that could equate, I guess, for all the more reason on pressure on the existing government, and that would probably translate into being moderately negative for the pound as well, because it would further push that view and sentiment. So something to just consider. Okay, quickly then to round off a couple of other stories. This was the other final thing I wanted to mention to you guys. If this doesn't make sense, hopefully I can give you just a brief overview of why this is quite significant. And Chinese stocks have gained direct entry to the MSCI's Global Benchmark Equity Index for the first time. I believe this comes after 3 failed attempts that they had in recent years. But this is very significant because it means that mainland Chinese equities, known as A-shares next year, will be included in the MSCI's flagship Emerging Markets Index. This decision opens a new front in investors' long-running debate over whether and how to introduce domestic securities into international portfolios. Now, just to give you an idea in terms of to quantify the size of the Chinese market, Chinese equity and bond markets are the 2nd and 3rd largest each respectively in the world, and yet foreigners hold less than 2% of each market. Now this is very important for China. The reason why they've managed to get over the line, if you like, and MSCI inclusion has been granted is because of this thing called Stock Connect. So over the last, I would say, probably 4 to 5 years, what's been happening is a Stock Connect program which links geographic area financial centers of China, so Hong Kong, Shanghai, Shenzhen, without the subject investors to the same capital restrictions they might face when buying shares on the mainland using the local currency. So it's an easier entry to now enter into that market, which goes to supplement this long-term pursuit of China wanting to be a global player or global trading partner on the international scene. This whole liberalization of their economy, their currency, that they'd been doing some of the tactics there as well. This is all a long-term play in China's move to global dominance, if you like, over the coming years and decades to come. So it is actually very significant. It does mean then that portfolio managers have, for the first time in a long time, the ability to be able to get some exposure to what has been arguably an incredibly difficult market to enter. But again, this is more kind of long-term strategies that will be at play here. Okay, rounding off calendar-wise today, very quiet. You've got UK data, public sector net borrowing, existing home sales come out from the US later today, and into crude oil inventories. So really fairly quiet on the calendar. That is really the summation of this week overall in terms of economic data. You have got Bank of England member Andy Haldane, who is a dove and voter. Given the dovishness heard from Carney, I wouldn't be expecting anything different from what Carney said. So reiteration of the dovish stance. Rates don't need to rise at this point, not with wages looking so anemic, as the governor termed. So I think things to watch today, rather than the data, is going to be more keep an eye on crude. There's obviously that key level we spoke about earlier, 42.20 downside in the futures. We're about $1 above there at the moment. But any further downside there. Cable still remaining fragile. I would keep an ear on the Queen's speech. How does that get interpreted? I would imagine they'll want to, the Conservatives, steer away of too many of the real kind of core Tory manifesto policies and look to focus more on Brexit in order to kind of appease the DUP, if you like, to then back through this initial legislative period. But keep an eye on cable because we're already below that key technical level. So a couple of things to monitor throughout the day, and hopefully a bit of insight as well through this briefing as to the dynamic of why oil has been trading in such a bearish fashion of late, and in fact into bear territory again. Okay guys, that's it then for your briefing. I'll let you get up and running. So have a good day, and I'll see you in the chat room. Thank you very much.